Comcast, CNBC's parent company, taking on Disney for 21st Century Fox's entertainment assets. So what would a win for either side mean for Rupert Murdoch's tax bill? Our own Robert Frank is back at HQ with that story. Robert.
Good morning, Morgan. Well, if this deal is done in cash, Rupert Murdoch could end up writing the largest check ever to the IRS, somewhere between $4 billion to $7 billion. Now, the tax issue has taken center stage in this deal. Murdoch might prefer an all-stock deal with Disney since he would owe no taxes with that deal. But Fox shareholders want the highest price since they would not pay taxes on either deal. I've spoken with corporate tax experts and people familiar with the Murdoch Trust. Here is how the Murdoch tax math breaks down. Comcast has offered around $65 billion for the Fox assets. Murdoch and his family trust own about 17% of the economics, so their pre-tax payout would be around $11 billion. Now, he would have to pay a federal capital gains tax on that, and since Murdoch lives in New York, he also has to pay the city and state income taxes. So his total tax bill on the $11 billion would be as much as $4 billion. But there's more. Now, the remaining Fox assets would be spun off into a new company. Murdoch and other shareholders would also have to pay a dividend tax on the value of that new company. That tax could be anywhere between $2 billion to more than $3 billion. So the Murdochs could owe a total tax bill of up to $7 billion when this is done. Now, one big caveat, the cost basis for some of those shares could vary quite a bit since Murdoch gifted a lot of shares to his children in recent years, and the tax on those shares would be a bit lower. But the vast majority of the shares held by the Murdoch Family Trust have a low to zero cost basis and would incur the full capital gains tax. Now, the Disney deal could have its own risks if Disney decides to sweeten its deal with cash. That cash, even if it's just a small amount, would trigger the dividend tax on the spinoff, so the Murdochs would prefer a deal that is entirely in stock from either company with no cash. Now, Murdoch on the board have said that they will act, quote, in the interest of all shareholders, and they have minimized this tax, although it's hard to minimize a $7 billion potential tax bill. Guys, back to you.
Yeah, Robert, that's a pretty eye-popping number. I mean, from an estate planning perspective, though, is there any other way that Murdoch could potentially structure this to not have a $7 billion tax bill?
The shorter answer is no. I could not find any standard way for them to minimize it. Now, you mentioned the estate tax. All of his trusts are designed to minimize or avoid the estate tax. All assets that are held in a trust, most trusts, unless it's a charitable trust or an offshore trust, all assets held in that trust are subject to capital gains tax. So I talked to multiple attorneys, people familiar with the Murdoch Trust. There really is no way around paying this tax if it's done in cash. If it's stock, you simply transfer the value from one to the other and there's no tax. But you can bet there's an army of attorneys and tax people working on this right now, and I bet even Murdoch probably doesn't know exactly how much tax he's going to owe with this deal.
Yeah, nice problem to have, though, when it comes down to it.
Yes, writing a $4 billion check to the IRS. Nice problem.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.